welcome to the Asset Revolution podcast, where each week your hosts from Arbor Digital provide educational opportunities for financial advisors and individual investors to gain knowledge in this emerging powerhouse that is digital asset investing. The Asset Revolution podcast is your connection to the future of digital assets and an opportunity for anyone to get off zero. Let's dive in. Alrighty, we are here. Dan, I am so excited for this conversation. For those of you who don't know, Dan Weiskopf is joining me today, who is a manager at Toroso Investments and also a part of their investment committee, if I'm correct, and has a very intense background in finance throughout many different spaces. We're going to talk about a lot of different things, ETFs, amplified data, transformation data, the ETF that you guys manage, and then, some high level things about digital assets in the crypto industry. But for financial advisors, this is going to be another option for if you want exposure to this asset class, if you don't want to own the underlying. So before we get into all that, Dan, please tell us all a little bit more about yourself and what you do.
Thank you, Mark. Thanks for having me. I'm really looking forward to this discussion. This takes me back to a lot of hats that I wear. Yes, I'm on the investment committee at Toroso. Toroso is an ETF boutique. Everything about ETFs we're involved with, whether it's launching them, managing them, trading them, educating advisors about construction. I'm known as the ETF professor, and I'm always talking about how structure matters.
That's your Twitter handle, right?
Yeah, ETF professor. I got into the ETF business about 20 years ago as an early adopter. And from my vantage point, as a former hedge fund manager, ETFs were going to be just a fund-to-fund solution that were going to be liquid and transparent, and people were going to manage them that way. And I was always about that access. A lot of people think about the fees and the low cost access and the tax efficiency. I love that part too. But when I speak about how structure matters, it's about building a portfolio that, has the potential to generate alpha or risk-adjusted returns. So that's my one hat. My passion mostly these days is in the context of block. And yeah, it's a mouthful as to a name. So sometimes we just refer to it as block. And we work with a lot of firms in a collaborative manner, and that's how we launched block with Amplify. So when I look forward, I am often reminded about 1998 and You've Got Mail, the movie, right? I don't know if you remember that movie.
Tom Hanks, baby.
And you know what? In 1998, there was this thing, the internet, and everybody was like, okay, cool, it's very cute. But if you look back at that movie, right, you remember there was two people who met. They were in the same industry, and the internet was going to be changing how they do business, right? That is one example of why the blockchain is going to be so powerful, right? In that people don't understand the change and disruption that's going to occur. In the same way they didn't understand 1998 with the impact on .com. So, here I am today, and I'm happy to explain further.
Awesome. Well, yeah, this is going to be a fun conversation. I love that you mentioned a little bit about that. And especially with your experience in the ETF space, we kind of look to you at Arbor Digital a little bit as one of those ETF experts, right? Because we manage we own the underlying of a full range of assets in the digital space. But we know that's not the only option. And for anyone who's listening here, they need to know what the options are out there for them if they don't want to own the underlying, right? So I love that. Let's go right into the ETF then that you help manage and co. There's a co-manager, right?
Of course, yeah. Our CIO, Mike Venuto.
Yeah. I see him on CoinDesk a little bit, right? He does a lot of guest appearances too, right?
He's very good at explaining things. Um,
Yeah.
yeah.
Okay.
So
Well, tell
so
us a
it
little bit about Block then.
yeah. So everybody is so excited, I think, about the price of Bitcoin or the price of Ethereum or just crypto in general, right?
Mhm.
And with good reason. But our focus on Block is about the actual companies that are going to be trying to capitalize on the trend, and it's really like an infrastructure play.
Yeah.
So and to some degree, I think it's more tangible for
Mhm.
people. And from a financial advisor's perspective, clients, if they want to own Bitcoin, they can just go out and buy it, right? They don't need a financial advisor if they
Yeah.
really want to make that leap. Now, to understand the companies, that's a whole different level, right?
Mhm.
And that's what I think we bring to the financial advisor with Block, which frankly we launched in 2018. That is over 1.2 billion in assets, and hopefully offering the right solution for folks who are interested. And how do we break down Block? Well, there are roughly 210 companies in the universe today, and we're adding stocks or companies to that universe every week.
Mhm.
And we break down the portfolio across 7 different segments. The miners are one segment, and the miners are a great example of the infrastructure. People think about Bitcoin, but the miners play a role in securitizing, right,
Mhm.
the network, right,
Yeah.
and they're solving that problem, and they're making it safe. And there are roughly 20 different publicly traded miners today that are out there, and we own 9 of them. And we got involved in the miners 2017 and 18.
Mhm.
And one of the things that we do as an active fund is we are, in fact, meeting with management, visiting sites. I think that's necessary. I think that's
Yeah.
important. We're a diversified fund that's targeted at the space. Now there are a number of funds that are out there now that are passive.
Mhm.
They have lots of concentration risk, and if you can manage that ownership, of a concentrated portfolio, that's great, right? Or we take the position that we're looking for the leaders, and we're going to be
Mhm.
rebalancing and changing up pretty frequently. So
Yeah.
that's one segment. You look like you got a question.
No,
You
no,
want
no.
me to keep
Continue.
going?
I do have a question, but I want to let you go. So you got a couple more segments to go.
Yeah, okay. So then the other big section is the transactional or the platform side. Listen, it's the Voyager, it's the PayPal, it's the Square, Mogo,
Mhm.
Coinbase. Now, a lot of those companies we've been long for years. Some of them are up and comers, but when you look at the ability to buy and sell these coins, there's a lot that goes in it, right?
Mhm.
Some of the platforms offer the option of 50 or 60 different coins, right? Some of the platforms own derivatives of the coins, but they don't necessarily offer the direct access, right?
Mhm.
And some of them are just offering 2 or 3. Some of them are even, regulated by different jurisdictions.
Yeah.
So it can get a little bit complicated. But in that case, we've got north of 15 to 20 different in our portfolio. Then we've got conglomerates and direct exposure as 2 different categories.
Mhm.
We do not own the crypto directly, but we might own, and we do own, or we might own, because it's an active fund, we can
Mhm.
make changes. MicroStrategies as a direct, um, or at one point we switched from GBTC to the Canadian ETFs, and we got rid of some of the tracking error and the discount issue.
Yeah.
Semiconductors are another category, and venture capital, or a third, sixth category, and then private blockchain. So we break it down. We have 2 meetings a week, and where we might be making changes. And our by the way, our investment committee is like 15 plus people, so it's pretty involved.
Yeah. So a couple of things to unpack there, because I love the fund and how it's built right now, and kind of what you guys do to build for the future as well. One of the things that really intrigued me when we were doing our due diligence for you guys was this idea that you had some segments towards venture and private blockchain. So you're not just getting access to public equities, and with the democratization of alternatives and all that stuff, I really love that this ETF provided exposure to that. So was that always going to be a conscious decision here? What and how has that maybe affected the ETF so far, or maybe into the future?
Well, we're trying to manage risk too. So at different points in time, we might own companies that are broader, and at different times we might own companies that are greater pure plays. Right now we're really heavy in the pure plays. We
Yeah.
think that people want that. That's the whole principle behind it, right? But in 2019, that wasn't so sexy, right? And we're going to go through different cycles. And when you get into the conglomerates or the private blockchains, we can manage some of the risk down, right? So that's why we have that kind of latitude. Yeah, so I think that's the answer to your question.
Yeah, no, thank you. And part of that, I guess, that due diligence and that research and analysis that you guys do, are part of these visits that you've mentioned a couple of times already. So I'd love for you to kind of dive into, what do those visits entail? What have you learned from those visits to these companies? And really just give, the audience listening, advisors, kind of a peek into what it takes for that. Because I know you've done a lot, and you actually have your own YouTube channel where you have these conversations actually recorded with a lot of these CEOs. And this is a shameless plug for you.
Thank you, by the way, I appreciate it.
So if you have, please go listen to those, go to that. They're fascinating conversations. But tell us a little bit now from your perspective, what have you learned from doing this research and analysis about the companies themselves?
Yeah. In 2018, I visited a mine that was in Oklahoma. It was a big warehouse, and it was the summertime. And one of the things I was reminded of by that visit, as an example, was heat is an important issue for the mining companies, right? And how you build the mine will affect the length, the period of time that the computers will last, right? Yep. So when I visited North Carolina recently, as an example, I also saw some of the facilities in their close proximity to the electrical power, right? Utilities. I mean, these are facilities that are paying millions of dollars on maintaining the bandwidth that they need, right? So when they're really far away from the power source, it's going to cost them more money.
Yep.
So that's one of those things that I learned. Then the question becomes, when you visit a site, how new is the equipment, right? Is it rusty? Because I've literally visited some sites where the equipment looked rusty. Is it clean, the facility, right? So I think the site visits are important. I've also visited Iceland, the Hive facility there. The jurisdictions is also important to learn about.
Sure.
Whether you're in Sweden or Iceland or New York, right, where I'm at, right, they're different issues. And so there's a lot happening in the mining, and I think that area is important to be visiting. When it comes to the platforms, I don't know that visiting Square's, offices will give me a whole lot of insights. Using the platform will,
Yep.
right? So we do that as well.
Yeah. You recently did an interview actually with Hive CEO, right?
Frank, yeah.
And Frank, yeah, yeah. And I think you guys talked a little bit about kind of that jurisdiction, which was fascinating. And you guys dived into proof of work and proof of stake, kind of those different consensus mechanisms, if they'll last. So when you first started visiting sites in 2018 and to now, it sounds like you've learned a lot about kind of what's important for these companies to be able to succeed in their business mandate and to increase production and be able to thrive and last. Because I think the growth of these companies has been crazy, right? What's the year over year that's been happening at some of these mining companies?
In what context, right? I mean,
Yeah.
some of these companies are growing. Most of these companies are growing exponentially, depending on how they're accessing the capital markets. At the end of the day, you might have seen some of these companies start with $20 million, $50 million, $100 million, and their ROI on the actual equipment with the price of Bitcoin going up
Mm-hmm.
is like 80%.
Yeah.
It's nutty, right? So there's a lot of incentive to raise capital by equipment, and then depending on the jurisdiction you're in, there might be different benefits. If you were in China in June, July, when you had to exit, it wasn't so pretty, right?
Nope.
But we got a benefit because most of the miners that we're involved with are in North America, right?
Yeah.
So they were not disrupted. And then what turned out to be the case is that it was easier to mine, so you were getting more Bitcoin.
Mm-hmm. Yeah, there's been this transition, right, from China, and now America was, I think the last study we all heard was, we all saw that was done was, US makes up like 37% now of
Yeah.
mining operations, which is great. It's good to see the US actually taking lead in one sector of the crypto space. That's hopefully a harbinger of good things to come. But let's kind of talk a little bit more about the kind of how you manage, because I love the way you guys manage, because tax efficiency you mentioned at the beginning was part. So for advisors, that's also an important piece, and the role of active management is important in that too. So talk about those two things: actively managing it, and then the tax efficiency piece, if you could.
Yeah. So at the end of the day, a huge benefit here is the fact that it is wrapped in ETF,
Mm-hmm.
and we go to great extent to optimize the creation and redemption process. And what ends up happening with the creation and redemption process is, I mean, you can make it complicated or simple, but the way I explain it is when there's a creation, it's similar in form to when a company buys another company and they're issuing shares,
Mm-hmm.
right? And when that happens, there's no tax implications, right?
Mm-hmm.
So that we would expect not to have any tax implications because of the creation and redemption process.
Mm-hmm.
And then there are also times when there's a creation and we've isolated different positions in cash in lieu, right? So somebody buys into our fund and we're holding back on owning more of that shares.
Mm-hmm.
And then we buy directly when we like the price better, right?
Yeah.
And then when we do one of our trades where we're managing the tax efficiency, the taxes go elsewhere with the market maker. And that's quite honestly a little bit extensive in terms of explaining. Happy to answer that question offline, if anybody needs more detail on that. But it's definitely something we're focused on, and you'll see the benefits of it.
Yeah. Well, no, especially, I mean, again, thank you for going into that. And especially for wealth managers who are looking to get exposure to this space, for them, they don't want so much unfamiliarity that it's too scary. So for you guys to have, a disciplined approach to that and how you manage the ETF, it also being an ETF wrapper, I mean, that's where I think this solution for advisors to get into the digital asset space, even if it's not directly on the underlying, is really where I think a lot of people should go, because it not only gets you exposure, but then it'll start piquing that intellectual curiosity a little bit more. Once you start, because again, when you look at your prospectus and you look at the fact sheets that you guys release, you guys are very good about releasing month to month analysis on the fund and what's going on. That intellectual curiosity gets piqued, and I feel like when I listen to you and a lot of your interviews, I sense that genuine intellectual curiosity. So let's like kind of transition a little bit to kind of that topic. You've taken this road and you've been in had your experience. Tell us a little bit about your journey. Maybe even Michael's also your co-portfolio manager here, or anybody else at Toroso, the journey of moving from this traditional side to now managing this type of ETF portfolio in blockchain that is the future. What was that journey like? Just the mindset shift and that intellectual curiosity. How did that get piqued initially?
I think certain people are early adopters and disruptors. And generally speaking, that's our culture at Toroso, right? Mike and I go back probably 15 years.
Yeah.
He was also big into venture capital and involved in a number of the companies that people know today at an early stage, including Wisdom Tree as an example. And when I look at a fund like Block, often people say, how do I position it, right? And you can buy a broad growth ETF, and that might make sense for some people. But if you want real growth, you've got to go to the thematic world, right? And I find that most people understand how they're going to achieve growth if they understand what they're investing in.
Yep.
Right. As opposed to, oh, I want the growth factor. Well, is Microsoft really that growth factor? Well, maybe, right? But at some point you're going to have, law of large numbers, right? Yep. So I've always been somebody who leans into the small cap area, and that goes back to my hedge fund days, right, and the venture capital side, and so it was like a natural extension of my psyche to move from just doing ETFs to actually looking for the next disruptive company in the blockchain, which, by the way, is going to change so many different industries, whether it's healthcare or insurance or consumer lending, right? Anyway, I don't want to
No, you know
deviate.
what? I just saw an energy come out. So dive deeper a little bit there for me. Where do you see this having huge impacts?
Yeah, so if you think about what the blockchain is specifically, it's a medium where you can put processes together, and the checks and balances are tri-party, right? And the transparency is real, right? So imagine, unfortunately, somebody has to go to the hospital, right? They check in, they've got all their records, they've got to pay bills, and you've got 8 different vendors that have to talk to one another, and you've got to make sure that patient records are protected. So all that stuff can be put on the blockchain and process, I think, much more efficiently. And we will go that direction. The technology is there. Let's talk about, lending a little bit too. One of my interviews that I'm going to be releasing very soon is with Michael Cagney. And Michael was was a co-founder of SoFi, and now he's the co-founder and CEO, I should say, because he corrected me on the interview, and chairman, executive chairman of Figure. And
Mm-hmm.
Figure is a fascinating blockchain company. It's private, so we were able to like really drill deep on some of what's going on, far more than I'm used to with public companies. But as an example, if somebody needs a HELOC, they can go the normal channel,
Mm-hmm.
and it might take 45 days to get that HELOC. On his platform, it might take 5 minutes. So which platform do you want to go to, right? And I'm talking today.
Yep.
Okay. I haven't tried this. I haven't tried it yet. I'm tempted to open a HELOC very soon from my
Well,
house.
so I'll play devil's advocate on that one. So usually for the convenience and for the speed, you usually compromise on something. So is there anything you're compromising, like security, trust, like when engaging in that HELOC? What did you learn about kind of the other steps of that process to enable that?
Yeah, I don't know. You always have to compromise on things. I think he's eliminating a lot of the middlemen.
Yeah.
Right. And the verification is, through automation. It may be that the way the system is set up, it goes right into the blockchain and his platform. A lot of what he's doing in the lending business is saving people money. Like we're talking about 100 basis points. It's definitely going to be a company to watch that's private.
Well, hold on. I don't know if advisors listening would be interested in saving their clients 100 bips on these types of things. I'm just kidding, obviously, but
yeah,
that's huge. 100 bips.
Yep.
Wow. And that's real. That's happening now.
It's happening now.
Yeah.
Yeah.
And it's interesting. Probably I haven't done a deep dive on them, and you've now piqued my interest there. I'd love to see, because it's probably, again, you talked about the transparency, right? Like when you go through that verification process on the blockchain, it's quicker, it's more efficient. And I think where people get lost and they still don't make this connection, it is way more secure than when you're doing through the normal traditional channels. And that security cannot be understated, right? When you're talking about, especially these types of trends, and I think these are large amounts that people are working with on this specific platform, right?
Yeah. No, there's like 2,500 people who are employed at the level of the mortgage side.
Yeah.
Okay. Another 500 on the other side, which involves firms like Apollo, where they're going to be trading some of the private equity deals.
Mm-hmm.
So imagine a private equity deal that actually somebody can exit.
Yeah.
Yeah. So
see, now you're getting into like tokenization and the ability to get access to private markets, and whereas traditionally what you give up by giving into private markets and all that is liquidity, right?
Yep.
Yep. What if that isn't a thing anymore? What does that do?
Right. Yeah. and what happens if you don't have a lot of market making that can cost you a lot of money, right?
Yeah.
You might have more volatility, right? But you can choose how to work that.
Yep.
So, and that's here now too, right? That's not a 2025 thing. You're going to see that in 2022 for sure.
Yeah. Well, and that's a reason why a lot of macro investors kind of see the volatility as a feature and not a bug, right? You hear that from them a lot, right? It's an opportunity to take advantage of right now. And why shouldn't you, especially in these beginning stages? So Yeah. Oh my gosh. This is great. I knew we were going to get into some really cool stuff. Um, the great thing I love about you kind of going into those two examples is because the purpose of this podcast too is to help advisors make tangible what's happening in blockchain, right?
Yeah.
And what we do a lot of educating on is they think, a lot of times we have a conversation with advisor, they see us, we're this separately managed account where we own the underlying digital assets themselves. So they think they're going to get some crypto evangelists who are like, crypto's coming to take your world and all that stuff. And when they find out, no, like we're very much almost the same ethos as Block is we see this as early stage venture capital investing, especially when you go further out the risk curve aside from Bitcoin and Ethereum. But this idea, what we end up educating them on is that there's a very different thing, but there's the blockchain and there's the asset, right? And two have to be looked at differently. And that's why I love the due diligence process and the thought process, the curiosity and the approach that you all are taking with the blockchain piece. And then getting those pure crypto plays and being able to capture that through these traditional vehicles that advisors are used to. I mean, it's like a no-brainer, right?
No brainer.
No brainer. No brainer. If you don't want to own the underlying, but you want to have some sort of plan, you want to start learning and you want to start getting into this space a little bit.
Yeah, I think it's definitely a better mousetrap. I'm totally on board with that. Right. I don't have laser eyes, if you notice, by the way.
Neither do we.
and I think you have to be objective, because
Absolutely.
if you're not objective, you're not really managing correctly as a fiduciary. So our approach is to be objective.
Well, I think that's one thing we aligned on when we were doing our due diligence of you guys. The first thing you said is our first thing, and this is exactly what we do when we go in and we talk about what our portfolios are, is we're trying to do our best to manage risk.
Yeah.
Right. To understand. And that's where we are fully transparent about, we have a fundamental understanding of some of the risk. And sure, when you say that, but there's still a lot of unknown risk, right? Like, even though we do all this due diligence and there's still the risks that we don't even know about yet. And that's where you have to be comfortable kind of going into that gray area. So I would love for you to maybe, like, let's talk about, as the last piece to this, talk about maybe going into that gray area and some of that risk and how you guys view going into that gray area.
Okay, so one of the things that we are proud of is avoiding, major calamities, right? Mm-hmm. And part of that is about how you size risk. So you'll see positions that are 1% in our portfolio. We have a range of 30 to 50 holdings that we will have. Actually, yeah, 40 to 60.
So the universe, you said, I think, was 200 plus companies, and then so you guys will hold.
So the universe is like 200 plus.
Yeah.
Right.
Okay.
So we'll hold about 50 names in the portfolio, right? And it'll start out as like a 50 or 1%, 50 basis point or 1% position, and then gradually, as the company proves out, that we get more comfortable their thesis, we'll increase it, right? We'll increase it maybe to 2, and if in this space, if it really works, it'll go to 3 pretty quickly, right? Mm-hmm. And if it doesn't work, we might lose 1%.
Yep.
Okay, I can lose 1% and not get blown up. We think that's super important. And at 5%, well, we'll probably be looking at trimming.
Yeah.
Now, having said that, the top 20 holdings represent a range of about 65 to 70%, but they've graduated to that level.
Yeah.
So I think that's super important, and because there are a lot of frauds out there.
Absolutely.
And we
so
don't
not just in the crypto space, but you see it in this space as well on the public side.
Oh yeah.
Okay.
Oh yeah. No, a lot. Yeah. And we've discovered, I would say, many that shouldn't be public.
Yeah.
And we just avoid them. And in case anybody's wondering, we don't go short.
Yeah. That's important. No, I love that you're diving in. I love we talk a little bit about this because and my first, so this is, you're actually going to be part of our first batch of episodes for this podcast. So
Cool.
one of my first ones was with Griffin Knight over at Blockchain. And we kind of talked about this different market structure and how these markets are very different, owning the underlying. And one of the things we talked about was in this space right now, it's not just important to have an idea of who the winners might be, but it's also knowing who when you see a possible loser, it's about avoiding them just as much, right?
Very much so. We're going to make mistakes. Let's be honest. We're going to make mistakes,
Yep.
but how we manage those mistakes is critical, right?
Absolutely.
And sometimes, how we enter a position is also critical. Like as an example, people don't think about ETFs participating in the IPO market, but we did, and we do, and we are constantly reviewing because that's going to be how we're accessing different companies. But we might start out the due diligence when these companies are private. So Stronghold is one that we recently bought into. That was an IPO, and we started talking to the company 6 months prior.
Yeah.
Right. So, Core Scientific is another one that we've gotten involved with, and we got involved with it through the SPAC because it's coming public, the SPAC, but it's actually a convertible that we own.
Okay.
Right? People don't think about ETFs doing that. So we're using the ETF as a wrapper.
Yep.
To facilitate an actively managed strategy.
I love it. Well, I love that we got to dive into it. I want to kind of transition now. It's hard to not talk about ETFs and not talk about what's recently happened, right? Where we got the first futures-based Bitcoin ETF approval. So quick, your guys' take, what's kind of been, and it's been what, almost 2 weeks now since it's been, or a week and a half since its launch. What are your thoughts so far and, on its launch and kind of what's been happening so far? Because, obviously, even though it launched, it's been pretty active, right?
Oh yeah. I mean, I think it's over $1 billion in assets now. One of the most successful launches ever in terms of gathering assets. We just recently put out a thought leadership piece about it specifically, and actually Mike Venuta wrote it. And we're thrilled about having it out there. And people may misread this, but we're calling it Frankenstein. And that's not necessarily a negative. It's just a warning, okay? Meaning that the buy and hold strategy for that ETF may not be the best way to manage it because you're going to have tracking error. What that tracking error is, well, I don't know that anybody knows, but because it's a 33 Act product and because it's got futures, you're going to have that. So what we're saying to people is, if you want to trade, maybe it's fine.
Yeah.
But if you want to buy and hold, there is probably a better wrapper out there.
Yeah. We have similar, and it was interesting because I know, we've been thinking about this for a long time, right? Like, I think this year is where the momentum, and there was just that energy in the space, even from the beginning, where this was going to be the year where we had some sort of ETF approved, right? 2013, the Winklevoss twins were the first one to try to apply for a spot ETF, right? And Rick Edelman comes out, and it's just funny. I think he said 18 months, right? And just every 18 months, he just keeps saying it. I always love that. But so I think you actually had an interview back in the summertime where you were talking about with somebody else on a podcast, and you guys were already thinking about what it would mean, kind of having a futures base versus spot, and how the tracking error would play into effect, and what's the way that they can mitigate it? Because I know we've talked a lot about it, but the way they mitigate that tracking error, it's by having the shorter contracts, right? The shorter time period.
Yeah. I think you're probably referring to our happy hours that we have every Thursday,
which I still haven't gotten an invite to, but we'll save that for another conversation.
Oh, they're open to everybody. You're invited. Yeah.
Awesome.
No, and if you look at what they've done with the futures based, it makes sense, and it's in that it's a lower bar from a regulatory
Yeah.
scrutiny standpoint, right? Which, well, I don't know if that's a good or bad thing, right? But at least it's out there.
Yeah.
But with the Canadian ETFs, they're actually holding
The underlying, right?
the underlying, right? So that's why we made that switch. We're not going to have the same tracking error versus the either of GBTC or the
Mhm.
future space.
Yeah. That was a really big important move for you guys for sure. It's a really
Yeah,
smart move.
you know what, and it's another example of how we move. So rather than owning just single one, one of them, we
Yep.
own three. So there's 1% positions
Yep.
in each of the three. We know there are going to be problems out there,
Yeah.
right? We do. We just want to manage the risk.
Absolutely. Amen. Wow. Okay. Well, thanks for diving into kind of that ETF talk for a little bit. I'd be hard pressed not to ask you about it, considering you guys are the ETF guys. But I'd like to kind of end this off with two things. One, I want to make sure people know where to go see your content, what you're doing, and all the work. But first, I'd like to kind of put a question on you to talk about kind of the future a little bit. You've been in the space and doing this due diligence, doing all this great work. Give us a sense, what's the future look like a little bit? Where do you see maybe a couple of areas that people should be paying attention to?
Oh, well, first off, one of the reasons why we were excited about launching the fund itself was because, as Mike Venuto likes to say, we thought there might be a chance that ETFs might get displaced or put on the
Mm-hmm.
blockchain,
Mm-hmm.
right? So I think the future could be in 5 years that people are trading securities more frequently on the blockchain. And by the way, again, the technology's there, right?
Yeah.
And a key benefit would be same day settlement, right?
Mm-hmm.
Which improves the system. It's
Yep.
more liquid, right? From an industry standpoint, where do I see the most change beyond just the financials? I absolutely think healthcare. I
Yeah.
think it's going to break it down between healthcare and insurance. Um, and so that would be my focus.
All right. Well, thank you for that. And again, if you're not paying attention, now you know where maybe to put some energy if you're listening. Well, great. Well, man, it's been so fun jamming with you on this. Dan, take these next couple minutes. Again, you put out a lot of great content for Toroso, for the ETF. Tell us where we can find you. What are some of the projects you're working on? I see that ETF think tank is in your background. So tell us a little bit all about that.
Oh, goodness. Okay, so on the ETF think tank, they can find some of our thought leadership pieces. So it's etfthinktank.com. That's specific to the ETF side of our hat. The TorosoInvestments.com you can get a broader understanding about the overall firm. Title is the entity that we launch ETFs through. Amplify is our partners on Block, and so you can just search for Amplify ETFs and you can find that. And there you can find our monthly piece as well as our holdings. By the way, if anybody's curious, we're 100% transparent in terms of every day you can see what we own. And then if you go to YouTube and you search my name, Weiskopf, ETF Think Tank, you can see some interviews with Michael Saylor, Alan Lane of Silvergate, Frank Combs of Hive. I've done about 10 of them. I'm sorry if I'm forgetting anybody. Am I forgetting anybody? Fred Thiel of Marathon. And we got a lot of surprises ahead on that. So anyway, Mark, thank you so much for having me here. It was a lot of fun, and hope I didn't ramble too much.
No, not at all. You've demonstrated kind of what we love about just this entire space as well, which is more about collaboration as well as competition, and it's
Sure.
healthy. It's great. Having these conversations and getting this information out there to advisors, so that way they have an understanding of how they can engage with the space on any type of level, whether they're at the beginning of their journey, in the middle, or at the end. You've provided so much tangibility to a lot of these things where they talk about that could be so esoteric, right? So it's been my pleasure having you. And we are going to have to do this again very, very soon.
Anytime.
Alrighty,
Love
Dan.
the insights. Thank you.
Yeah. All right, everybody. Thank you for listening and joining. Be sure to check Dan out, and then we'll be seeing you again very soon. Bye, everyone.
Bye-bye. Thank you.
We appreciate you listening to this edition of the Asset Revolution podcast. I'm your host, Marc Nichols. Please don't forget to let us know how you like the show by rating and reviewing us on Apple Podcasts or wherever you like to listen. For more downloadable digital asset resources and educational opportunities, please visit us at arbordigital.io. We are here to help you get off zero safely and securely. Thanks again for tuning in, and be sure to tell someone you care about them. Cheers.
We are financial advisors. However, we are not your financial advisor. Unless you're under contract with or actively speaking with Arbor Capital Management or Arbor Digital, a division of Arbor Capital Management. This podcast is just that, a podcast. It is not financial, legal, or tax advice. If you have individual questions, please reach out.